Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to Small Cap Discoveries conference call. Today we have back CEO Obie Strickler from Grown Rogue. Grown Rogue trades on the CSE exchange under the symbol GRIN, and it also trades on the OTC under GRUSF. The company is currently trading at 71 cents with about 171 million shares outstanding, or about $121 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, great. Thanks, Trevor. Yeah, great to have Obie back. Obie, it's been a little while since we spoke last. You got a big grin on your face. You got a grin on my face as well. I think we started talking to you, I'm going to guess about a year and a half or so ago, and stock was trading around 10, 12 cents. I can't remember the exact number. We had a lot of interesting things to talk about back then. Your stock's not trading at 10 or 12 cents anymore. It's significantly higher. That's why the smile's on your face. And the word grin seems to be appropriate here. So anyways, great to have you back. We're going to talk about Grown Rogue here in a second. We've got Obie is going to, before we sort of get into the Q&A, Obie, why don't we tell some of the subscribers that maybe aren't familiar with the story, why don't you tell us all what Grown Rogue is all about?
Yeah, and thank you guys for having me back on. It's definitely been a quite the ride since our first kind of discussions, 18 months ago. But I think that's what makes you and your kind of platform so special, is finding and identifying companies like us that are, early but profitable, have a good business, good management, and are about to have kind of a re-rating, kind of an inflection point in the business. So yeah, can't thank you guys enough for giving us the opportunity and supporting us early. So yeah, those of us who don't, or you that don't know Grown Rogue, welcome. Obie Strickler, co-founder and CEO. We're in the cannabis space, as I'm sure you're all aware of. Our core focus is high quality, low cost flower. We exist in very, very competitive markets. Our headquarters is in Oregon. We've been operating in this state for 6 or 7 years. We operate a facility in the Michigan market, as many of you know, in cannabis, another highly competitive, marketplace across the U.S. We recently, last year in 2023, took on a partnership with Goodness Growth, formerly known as Vireo, another publicly traded cannabis company in the space. Their main assets and facilities are in Minnesota and Maryland. Our agreement with them is really to provide cultivation kind of leadership. And we partnered with them to improve their process, their systems, increase yield. We're compensated through that through like a performance structure where, we only make money if they make money, which is something that is just really kind of core to who I am as an individual. Like, we're very comfortable standing behind the operational efficiencies that we bring to the industry. Also in 23, we launched a partnership in New Jersey. It's one of the most exciting markets in the US. Pricing is very good, competition super low. Timing for that is really kind of advantageous for Grown Rogue, mostly because the capital markets for cannabis are so closed. And so that's why you're seeing continued kind of elevated pricing. And the goal of Grown Rogue, after establishing kind of the core operational efficiencies in, from beginning, but through like 21, 22 was, great, Obie, you got this cool business. It's profitable, 30, 35% EBITDA margins in these highly competitive markets. No one else is able to kind of achieve that, but you're in 2 states. Can you scale it? And that's really been the focus we took in 23 was, okay, great. We need to show that we can scale, not only through being able to access some capital to help with that kind of, advancement across the US, but more importantly, I think a lot of people miss this, is the talent and ensuring that our team could actually expand and scale and take on more responsibility. And so that partnership with Goodness Growth was a really good step in that direction. Gave me a lot of comfort to go after the New Jersey cultivation asset. We think construction will probably be done by the end of March. We expect to have sales with our partner, Abco Garden State, commencing sometime in Q3 or Q4. Once you get construction finished, you got to get inspection approvals. You got to then populate the facility with plants. Takes a few months to get a harvest down. Then you got, all the process to get it actually into the market. We recently kind of did our first kind of, foray into the retail. And so we were a small kind of minority partner, more of a passive stake. It's still a pretty big, we'll end up owning like 35% of this entity in West New York, New Jersey, which is highly like just a super limited market with regard to access to other retail. I think it's the only retail store within like 4 or 5 miles. It's right across the the river from Manhattan. It's one of the most densely populated areas on Earth. The McDonald's across the street from our retail location, I think, was a top 10 revenue generator for all McDonald's in the US, maybe even the world, and it has no drive-through. So it just gives you an idea of how much traffic is, daily traffic is going through that region. And that's kind of an area, the reason we're kind of branching into retail a little bit, mostly in states where definitely in states we're already operating. It allows us to have a little bit of a captive partnership, which ensures some shelf space protections for us. But we also think the quality of our flower in these markets like New Jersey is going to be a huge boon to our retail partners in those markets, as we be a little bit more selective of where we place our products. So that was kind of, where we are, what we did, what we did in 23 to kind of grow the brand and, kind of the footprint. And then the other thing, obviously we're not just done with Jersey, that's not the end of our kind of expansion. We're working on our next state already. We expect to have some more news on that in the coming weeks. And so, yeah, just, low cost, high quality, profitable and very competitive markets, moving into less competitive markets where hopefully we'll capture more margin in the short term. And, our goal long term is to be in, 10 to 12 states, kind of with our box. Like the other thing that's really important to Grown Rogue is where we sit in the cultivation kind of landscape. There's really kind of 3 broad categories. There's kind of mass market production, where they talk in terms of biomass and, they're producing, tens of thousands of pounds a month or whatnot, like just big, broad scale. And then you have what we call the boutiques, which are, kind of like my national director of cultivation, if he had his own little like 1 or 2 room grow, would be a boutique. Not scalable, like he runs it with a small team. Not that he does this, but that type of quality. And it's an unscalable kind of system. And they become very localized, very, kind of like a 1 state operator, maybe only selling to a small portion of that state, doing a few 100 pounds a month. And that quality is like amazing. Where Grown Rogue sits is in that craft kind of sweet spot. So we like about 50-ish thousand square foot buildings, 1,000, 1,200 pounds a month of production, where we bridge the gap between damn near boutique quality, while also having the, scarcity, high demand, big sell-through on our product, very low inventory levels. And that's the solution we want to take forward, across the US as we continue our expansion.
Mm-hmm. So, Obie, we see so many players still in the space right now, and there's still so many that are struggling. What are you doing right, and maybe what are they doing wrong?
I'll focus more on what I think we're doing right, rather than, don't ever like to talk bad about our, peers and colleagues and whatnot. I think the things we're doing right is, we really care about the product. Like we're passionate about this space. We definitely, we got into it to make money. We want to make money for our shareholders. My wife, Sarah, and I are still the largest shareholders in the business. But we actually really care about the product. We care about the customer. And so we're trying to make sure that they get a really good product. We want to be price sensitive, make sure that they're getting a good value for what we provide. So that's really important. We understand how hard this business is too. This is not software. This is a manufacturing kind of agricultural combined business. And so the intensity you have to take is pretty amazing. I had this epiphany this morning as I was sitting, kind of before work started, 6 a.m. up, just thinking about, what's different, how do we continue to compete? And I'm a big basketball fan, played basketball in college. My wife was a D1 athlete, and the All-Star game just happened. And I was watching the level of intensity in that All-Star game. And for any of you basketball fans, it's kind of a joke, right? They're going through the motions. They're not playing hard. And I was like, oh, like that's one side of it. That's probably these non-competitive East Coast markets where pricing is $4,000 a pound. You can go through the motion. You don't need a lot of intensity. It's not very hard. You're still going to make money. Then you go to like playoff level intensity. And that's the intensity we have to bring every day to be competitive in Oregon and Michigan. And it's the same intensity we want to bring to, these more non-competitive markets we're moving into. And it reminded me a lot. I was a big Kobe Bryant fan growing up. Unfortunate that he passed away, but when you watch him play in the All-Star games, he brought that intensity. And it's just, kind of dawned on me that's a big kind of advantage that we bring. Like, we understand it's going to be a knife fight. Like, we're here to work, we're here to get the job done. The third piece I think is really important is just, we're very lean. We run a very lean corporate infrastructure. Like, our SG&A costs as it relates to overall revenue is some of the best in the US. And that translates all the way down to our operating expense. And so profitability is important. And so those are probably the three biggest things that we bring that I think are very unique to Grown Rogue and what we do.
Perfect. I want to remind everybody at this point, listen, if you've got a question you'd like me to ask Obie, please use the chat function, and of course I'll ask that question. Obie, what's, since we last spoke, has there been any sort of industry trends or any changes, maybe regulatory wise? I mean, you operate in the States, by the way. I mean, for everybody that's listening, you're solely operating in the States. You've got a couple different states that you operate in. You don't do anything up in Canada, so you're certainly not competing up here in Canada. But what's happening in the US landscape?
Yeah, I think you're seeing a continue increase in competitive nature. We believe long term, every single market in the US, which are almost like individual markets at this point, you can't ship across state lines. There's really a lack of connectivity. Will end up looking like the competitive markets we operate in. So kind of globally, you're seeing, where's the growth come from? And most of the growth is coming from new market expansion. And the problem right now is a lot of companies had already done their expansion, realized some of the markets were very difficult, got over leveraged on their balance sheets. As you look at a lot of the balance sheets in the industry, they're just leveraged to the teeth. And so they've been trying to play a little bit of defense. And with defensive nature, closed capital markets, increased competition, people are starting to wonder, where's the profitability going to come from? And that's why I think you've seen this big kind of, pressurized component on stock prices recently. I mean, Grown Rogue's kind of been an outlier in that with our performance, over the last couple of years compared to like the broader peer group and like MSOS, which is one of the big ETFs that tracks. What you're seeing recently, so that's kind of in the last couple of years, kind of just this reckoning of where you need to be and where you need to position yourself in this industry to be successful. What you have started seeing a little bit is more kind of regulatory improvement, for lack of a better word. Like the DEA, not the DEA, HHS came out with a rescheduling, recommendation to the DEA. That kind of made a little pop back in like the end of August. And so there's some excitement that we're going to get probably a move from Schedule 1 to Schedule 3, which would be a huge catalyst for the industry at large. I don't think it materially changes the way these businesses function. A lot of people believe that, with 280E rescheduling or with rescheduling, 280E will go away. So you're going to get more cash, especially in the retail heavy, kind of organizations to drop to the bottom line. Our prediction is that will be a 6 to 12 month, maybe 18-month kind of boom. But what you're going to have when you have more cash available, it's just going to further accelerate the competitive nature. Right? Company A is going to be like, great, I have an extra $1 on the balance sheet. I'll lower prices by 10% and I'll try and drive more traffic. Company B is like, oh crap, I got to respond to that. And pretty soon those additional profits are going to get eaten up, which I think you'll start to see over the next, kind of 12 to 18 months.
Gotcha. Now I was going to say this question for a little bit later, but might as well ask it now. I mean, your business has grown quite a bit. Your share price has obviously grown quite a bit. Any sort of large moves from here? Like, are you? You mentioned there's another state you're going to walk into, but it sounds like, are you doing that on a licensing basis, like these partnerships you've done, or are you looking at a big expansion where you're sort of replicating what you're doing in Oregon?
Yeah, so the way the Goodness Growth deal we have is kind of an outlier. That's okay. It's actually like an independent consulting agreement. So we're not the owner of that project. We're not the final decision maker. Our deal in like New Jersey, which will be similar to Oregon and Michigan, where we're actually in Oregon, we own 100% of it. in Michigan, we're the majority owner of that business. And we're going to start buying that down over the next year or so as we take just more and more control of that. Our preference is to be more like Oregon, Michigan, New Jersey. And even in New Jersey, there's some regulatory stuff we have to go through. We have an option to acquire up to 70% of that business, which we'll do in due time, or complete in due time. But our core goal is to be kind of owner operators. That being said, we're very opportunistic. I get asked this question a lot, like, what's your strategy? And the strategy is simple. We want to be the first kind of nationally recognized craft flower company. And in order to achieve that, we want to be in 10, 12 states over the next 2 to 5 years. Where I'm really flexible on is the details of how we accomplish that. And so whether that's through more partnerships like with Goodness, and we've had some of those discussions with other organizations where they need kind of our expertise and help, whether it's through owned assets, which is kind of our preference, but we're not so rigid that we're just like, no, but it has to be this way, or we're not going to do anything, because this industry is just, you need to be very nimble in our experience.
Yeah, financing. Would you be looking at financing this? Do you expect to be able to sort of grow through cash flow? What sort of do you envision your capital requirements over the next, say, 2 to 5 years?
It'll depend upon the speed at which we go. The way we look at future financings is, is the dilution's kind of a broad term to govern, like you're going to add more shares. But really, dilution's all about earning value per share, right? And so if we can go raise more cash, that will create more value for our existing shareholders and the new shareholders. We look at that as, what's the best way to manage our expansion timeline. And so we're not in the need for any cash. Our balance sheet's super strong. Probably some people don't know, but the convertibles we did in the end of 22 and 23 had a warrant attached to them, a half warrant for each one that had an acceleration clause. We've hit that acceleration clause. And so we're probably going to push, that kind of formal acceleration out to our investors, in the coming week or two. There's about $4.7 million US worth of cash sitting there in those warrants that will get exercised, and they're all well in the money, right? I think the warrants are at 24 and 28 cents. And so those investors who, the ones from July, right, they're up 300% in 6-7 months. And so they're very, very happy with that structure. And so that's a way for us to kind of access capital that's already kind of in our issued and outstanding shares. Whether we go to look at other financing avenues is really going to depend upon, what the business is generating, and fundamentally how fast do we want to go. And one of the things we're very cognizant of, Paul, right, is, this is a marathon, not a sprint. And I think a lot of people early on in our space got caught up in the frenzy of you got to go, 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 go. But again, like, we don't want to outgrow our team, our talent, and we definitely don't want to become, we're very disciplined with the way we allocate our capital. We have some of the best ROIC in the US. Part of that's because, I look at every dollar we get like it's my own. And so we're very thoughtful in how we deploy cash. But if we need it, we'll go get it, but only for something that makes a lot of sense for us.
Obie, you mentioned you and your wife are the largest shareholders of the company. What percentage of the business do you own?
Yeah, Sarah and I think we own 20%, just under 20% now. It's like 35 million shares. And that's one of the things I think is so unique to Grown Rogue as well is the primary shareholders in Grown Rogue, like the top 10 shareholders probably own 60% of the outstanding float. And they're very patient. Like my wife and I haven't sold a single share. Bengal Capital is our second largest shareholder. They own, 14, 15%, haven't sold a single share. Aaron Edelheit from Mindset Capital, another huge supporter of us. I think he's about to go over 10% holdings in Grown Rogue, hasn't sold a single share, buys in the market. Like we've got a really strong, supportive kind of investor base.
Fantastic. Always extremely helpful with a good shareholder base. Okay, well, let me take a couple questions. Got 2 here. Let's see what we can do with it. Gilles asks, can you talk about the New Jersey market? How many competitors are there? Is the number of licenses limited to a few producers? We'll go with those 2 questions first.
Yeah, so New Jersey is a very limited license market, mostly at the local level. It's really hard to get local approval. And you couple that with the fact that real estate's very difficult to come by. So like most of the industrial, and someone was talking about this the other day, I forget exactly why, but like there's almost no industrial availability in New Jersey. And that's because it's just, there's a bunch of shipping requirements there where people are storing things. And so a lot of the industrial real estate has kind of been sucked up by other industries. And so the building that we're able to find through our partner, because he's very connected in the real estate world, is fantastic. Retail is picking up a little bit. I think when we first started looking at Jersey about a year ago, there was like 30 or 40 retail. I think it's up to 100 now, which is good for us. Like we want enough retail kind of diversity to have enough shelves to put our products into. On the cultivation side, there's very, very few cultivators. Almost all of the cultivation there is dominated by like the big kind of original, I think they were called ATCs, like alternative treatment centers, you know, which are like kind of the bigger MSOs. And it's one of the best markets for them. I think Verano, and I mean, this is amazing for what they did. One of the big MSOs, they're actually one of the ones that I think is doing a pretty good job in terms of profitability and kind of controls. You know, they started segmenting their states, which no one does. Like Grown Rogue does that. We break out Oregon, Michigan, our partnership with Goodness Growth. We're very transparent. It's their largest wholesale state in the US. And so that goes to show you like the opportunity that sits for Grown Rogue with our product quality, our kind of price regime. And so currently very low competition. You know, the rumors are, and, you know, we're not in the market yet, but we have people doing research and we're talking to folks like, you know, a pound of, you know, cannabis flower in that state is selling for, you know, 3,000 or more. That same pound in Oregon and Michigan is probably at 1,000. So about a 3x price differential.
Wow.
The timing of when that will kind of, because like I said this earlier, we think every market will look like Oregon and Michigan eventually. The question is, how long does it take to mature?
Right.
And time will tell in Jersey. I think you'll, as long as the capital markets stay closed, which they still generally are, there's no cash to build cultivation. Number two, cultivation is really, really hard. And investors are getting more savvy to the fact that you can't just hand someone $5-10 million and say good luck. Like you got to show experience. You know, you've got to have kind of that pedigree of expertise in order to deliver a high quality cultivation center. And so we think, you know, we've got years, hopefully. But again, like this is the beauty of Grown Rogue. Like we don't want to operate in Oregon and Michigan because we like to capture more profits. Good for us, good for our expansion, good for our shareholders. But we're actually very prepared for that. And then, you know, Jake, who you guys know a little bit, runs IR for us. You know, he's talked about this quite a bit. He thinks because of the outsized market capture of the big MSOs in Jersey and the leverage on their balance sheets, if Jersey pricing goes down too much, it puts a lot of undue pressure on them. They kind of need to keep it up. And so we think we might benefit from a little just, you know, kind of natural kind of elevated pricing, you know, for a longer time period.
Now you mentioned that, you know, New Jersey's getting roughly $3,000 a pound. You guys are getting $1,000 a pound in Oregon. What's your cost of production? Like what is a pound cost you guys produce?
Yeah, so we like to, because there's not a lot of standardization across the industry in terms of how you compare apples to apples. So we like to use an adjusted break even, which is all in, includes all corporate. You know, our target's in the 600, but we're always definitely generally below $700 a pound. Our cash cost of production, like how most people would define COGS, is in the $300 to $400 range. You know, then you add a little bit of the corporate costs on top of that. And so, you know, we don't expect to be at that level day one in Jersey, right? There will be some startup, some learning the facility, the way the rooms work, but you know, like we're like, okay, so we're at $1,000 a pound selling it for $3. You know, we're still dropping $200 or $2,000 to the bottom line per pound, you know, versus in Oregon, you know, we're at, you know, $400 to $500, which is how we get to our 30, you know, 35% EBITDA margins.
Yeah, gotcha. Amazing. Okay, another question. Can you talk about your relationship with Mindset Capital and Bengal Capital? Bengal, I think you mentioned, was one of the big shareholders.
Yeah, it's amazing. They are similar to you, Paul and Trevor at, you know, here at the small cap is
smashingly good looking. Obviously, that's what you meant. Yeah,
that's exactly what I was going to say. Exactly. Josh Rosen in particular will appreciate that because he is. They found us early, and
Yeah.
Bengal in particular. I mean, they first started talking to us in the summer of 2021 as our ultimate strategy and where we wanted to be was still kind of, it was a dream and a vision, but there was a lot of work to do from then to now. And they've been, I mean, Josh is maybe one of my closest advisors. His partner Jerry, I talk to regularly, another very, very strong supporter. Sanjay, his brother Vijay, like they're amazing individuals, highly supportive. I can always pick their ear, give great advice. And again, long-term shareholders. They're, I think again, the second largest shareholder, haven't sold a share. And it's all, I mean, they're an insider reporter now, so we would ever see if they started to move any of their shares in the market, but just wonderful. And then Josh and Bengal actually introduced me to Aaron at Mindset Capital. And I think I mentioned again earlier, Aaron is, I think, a 9.9% shareholder. Aaron's the one who converted his December convertible early, like almost 2.5 years early. Didn't need to do that. It's going to shave us interest expense. He's been buying in the market. He's just, I can't speak highly enough about those two organizations and then the individuals behind them, and just their support and commitment into the long-term kind of plan that Grown Rogue has. They're fantastic.
That's awesome. And when did they originally become shareholders?
Bengal's investment was in December of 21.
Okay.
And they did a private placement. And then Aaron's first investment was in December of 22 when he did the convertible. And then he also participated in the July convertible that we raised. And then the other kind of big investor in that deal in July was a Bengal kind of contact that came in and wrote a big check to us.
Gotcha. But what's, I mean, you were, I say somewhat unknown, a year and a half ago. A lot more people are talking about you now. How have things changed from an investor relations or investor contact basis? Are you getting a lot more calls? Is it mostly retail investors? Is it institutional? What are the phone calls like now?
We're definitely seeing both sides of that. Retail, I think, is less communicative as it comes to like calling and reaching out. But we've been seeing a lot more kind of institutional interest, from smaller US funds. There's been several banks in Canada that have kind of reached out more recently around, marketing the story, supporting us in some way. Some are probably just looking to, figure out how to do a financing for us to clip some wages, which is, is fine and expected. But I would say the amount of inbound interest, not only from investors, but also potential deal flow, has been significant. We promoted Jake Ayat recently. He's now our VP of Investor Relations, big early investor. Has been with us for a few years, and he's been doing a much better job at communicating. We're trying to get some analyst coverage, like just as we go through another kind of inflection point. And again, us, we spend very little on IR. Like we don't pay, research funds. I think we have a market maker. It's like $5,000 or $6,000 a month is all we pay in IR outside of like our internal team. And so really a lot of it's organic. And I think people appreciate that about us, where it's not a bunch of paid promotion. Like we're down to earth folks. We do a lot of the work ourselves. Things like you and Trevor doing for us here, putting us, I did a podcast with Jesse Redmond, the Water Tower Hour, last week. And, it's that kind of stuff where we're getting more people who are, Grown Rogue's doing something different. We're profitable. Our stock's outperforming. We're actually, people talk about our peer kind of, and I got asked this question the other day, and I challenged the group. I said, who are our peers? There's no one that operates in the markets we do. There's no one that's wholesale only. There's no one really that's focused on like, based on the West Coast that's doing well. Like who is the real peer set for Grown Rogue? And I think that's starting to get people to think, to go, how do you value an organization like Grown Rogue that is actually kind of not isolated, but unique in the approach that we're taking into the markets? And I think you're seeing some of that reflected in the stock price.
Yeah, I agree. Obie, we've come a long way in the last little bit, but I imagine there's still challenges you face. What sort of currently keeps you up at night?
the knife fight
Mhm.
every day, right? Like
Every
it's
morning
that,
you get up, you sharpen the knives, and you go back to
yeah,
work. Yeah.
it's that playoff intensity every day.
Yeah.
So what keeps me up at night is just the unknowns. But that
Mhm.
being said, with the team that comes to battle with us every single day, I sleep really, really well.
Mhm.
You know, people ask me that question. You know, we're constantly challenging our strategy, like is what we're doing right? I mean, that's one of the things
Mhm.
as the CEO and, you know, someone that's responsible for looking out into the future and seeing, you know, the roadblocks or the pitfalls.
Mhm.
But like we're really confident in what we're doing. It seems to be working. Will we adjust as necessary if we have to, of course? Um, but it's pretty unique. And
Mhm.
so very little, I think, you know, kind of keeps me up at night worrying too much these days. I mean, even
Mhm.
when whether stock was down, like 2021 was a pretty awful year with some of the growth that we took on and kind of not
Mhm.
quite appreciating the continued level of disciplines we had to implement. And so
Mhm.
as a, you know, a new CEO, like a leader, I'm getting better at understanding, you know, cash timing, you know, making sure we don't put ourselves under undue cash pressure and stress, which we've done a really good job over the last, you know, 2 years of managing. We want to
Mhm.
continue that. Um, but no, I mean, mostly it's about opportunity and the excitement. And then, excuse me, quite frankly, tempering that so we don't get cocky,
Ahead of
arrogant,
yourself. Yeah.
you know, lose some of the disciplines that have got us to this
Mhm.
place. Like as our company gets better and more financially secure, you know, some of the things that got us to this point, we start wondering, is that necessary?
Mhm.
Like we still look at cash every week,
Mhm.
right? There's certain things that we set up when we had to that I'm like, we can't lose that. Like if we
Mhm.
lose that, like we'll just start to kind of slowly veer off
Yeah.
course.
Yeah.
So we're just maintaining those disciplines that got us to this
Mhm.
point. We're going to continue them forward.
Yeah. No, good on you. Okay, so we're about to wrap up here. I was asked the sort of same last two questions. What, you know, as investors watching you guys now, what do you think are the most important things to really focus on? What kind of metrics or maybe catalysts should we pay attention to?
It's amazing. I could turn my computer around and show you my board. It's four things:
Yeah.
New Jersey execution,
Yeah.
cost control, yields, sell through. That's it. If we do those four things this year and continue to do them, I mean, New Jersey execution is like the next state execution, but that's the one
Mhm.
that's front and center.
Yeah.
But it's those four things. If we deliver those four things going forward, and that's why they're in board as my 2024 priorities,
Mhm.
like we'll continue to perform exactly how we have been. And
Mhm.
with new markets coming online, the company's just going to get bigger and bigger.
Mhm. Um, you know, the first time we spoke, stock was, I think it was 12 cents when we first spoke. It's now gone up about 5 times in value. I'm hoping the next time we speak, we can come back and say it's gone up another 5 times in value. We'll see about that. But until then, is there anything you want to make sure you know everybody that's listening today walks away with? Is there any key message you want to make sure everybody knows?
um, Nothing like super key. The one thing I tell most folks is Grown Rogue is we've been in the business for a long time, but we're kind of a new story that's being discovered by
Mhm.
uh, not only cannabis investors, but just value investors that
Mhm.
see what we're doing. And I think, you know, the best is yet to come. And if you believe in this space long term, that there's value here, we're not the best trade. There's probably better companies to go trade. If you're looking for a 1 week, a 1 month, a 1 quarter, like Grown Rogue's gonna like I think we're a 2 to 5 year type thoughtful strategy, and there'll be peaks and valleys where you can make some money, take some chips off the table. Um, but if you believe in cannabis long term and you're invested in this space, like having exposure to us is a really good idea. Even at, I still think we're undervalued. I mean, Aaron put
Mhm.
out a podcast I did with him like a month ago, and you know his words, not mine, but they're pretty accurate. Like he laid out where we should be from an EBITDA perspective coming out of 2025 with Jersey, with the next market that we're targeting, with our partnership with Goodness, with our existing states. It's I I want to be back here in a year. We'll be back sooner than that, but I
Mhm.
want to be back in a year and we're talking about, hey, last year was a 5x, now it's a 10.
Yeah.
And I think we can get there. I think we're, you know, we've been running pretty heavily, but the best is yet to come still for Grown Rogue.
That's a great way to end this, to hear you say that. And I don't want to see you lose your grin. Get that pun in one more time. This has been awesome. We've been speaking with Obie Strickler, CEO of Grown Rogue, symbol GRIN on the Canadian Stock Exchange. I think it's still called the Canadian Stock Exchange, the CSE. Always a pleasure to speak, Obie, and continued success. And we certainly look forward to catching up with you the next time.
Yeah, thanks so much for having me, and for all the listeners that came in. Really appreciate it. So thank you.
Appreciate it. Bye for now.
Thanks.